really mortgage arrears rates in Australia are still very, very low, despite obviously the cost pressure of interest rates. Why is that the case? Well, people would prefer to pay for their house mortgage over a $400 retail dinner at a hospitality event. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into all sorts of asset classes. Yes, it's like a smorgasbord of assets. We're going to go to the asset buffet and see where it takes us. I'm a big believer in building wealth. I'm a investor. I'm a professional investor. I love getting involved in all sorts of assets out in the marketplace, whether it's the share market, the real estate market, the business market. I've got my tentacles in those places. So today I want to talk about, well, where to next for growth investments when it comes to how megatrends are influencing what is happening with the populace and what is happening with governments around the world. Maybe we can make sense of that and make some money. So today's show, I'm talking about asset classes of which I'm not licensed to talk about. So everything today is really just a personal opinion. It is not actually advice. Do not do anything I'm about to tell you, because you should probably see an advisor to help build your wealth. I'm merely just sharing what I'm up to, and I hope it might trigger some ideas in your world as to potentially how you go about investing. So I hope that's clear. I do not want any responsibility when it comes to what I say today. But hey, I'm an investor. I get out and about. I'm not a speculator. And I like the idea of long-term investments. That's what I'm all about. But hey, if it's your first time tuning in, welcome to the show. Play the show in double speed. Get your life back. All the episodes I've done are lessons on real estate, so feel free to go back over time. And of course, welcome back regulars. If you're not familiar with me, my name is Sam Saggers. I really coach people on real estate. I help people invest in primarily real estate. But equally, I love getting involved in other investment opportunities. I'm looking at some franchises at the moment with my old mate Fritz. I'm up to all sorts of stuff, but real estate's really my backbone. I think having a backbone asset class you're good at is very important. It allows you to explore other asset classes, but if you've got one which you know well, you feel pretty confident to grow your investments. I know the real estate market well, so most of my investments are tied up in that space, but I do dabble outside of the real estate market. And I probably shouldn't say dabble. I invest outside of the real estate market. And I think it's an important distinction, because obviously there are plenty of assets where you do dabble, you speculate. There is a difference between investors and speculators. Speculators obviously are looking to almost, take a gambler's approach to buying assets and selling assets. It's a little bit more fast and furious. As an investor, I follow a key concept known as the defined duration effect. I'm a big believer in an asset will go through a cycle. Everything's connected to a cycle. And the defined duration approach effect is just understanding how to take an asset through to its maximum potential by understanding a defined time frame. And the defined time frame in real estate is 18 years. In equities, it's 17 years. In the commodities market and the gold market, it's more like 30 years. So if you're going to get involved in those assets, you need to understand the time horizon and see if they line up with what you're trying to do. And I think one of the hardest things of being an investor is that application of the defined duration effect. Obviously, for a lot of people during that cycle, an 18, a 17-year, a 30-year cycle, a lot of people struggle to hold on to their investments. If they're going down, they start to wig out. And of course, if there are all-time highs on investments, people start to go, well, I better take the money and run. And really the key to the whole principle of long-term is to deal with the lows and deal with the highs and move beyond that phase to a completely new economic cycle. So that's what I pride myself on. That's what I get up to. And of course, when it comes to in the new world, if you like, the world is always shifting. There's always global economic shifts. There's always business cycle shifts. There's always innovation. And I think the way I like to invest is to study urban trends, to study world trends, to study what's fracturing in the world, and see if I can find some investment opportunities by understanding really what is happening and what the powers that be and what the populace really wants from society, whether that's real estate or whether that's a certain business inside of the share market. I'm very interested in that space. So if you think about it, we're living in this kind of current climate positive era with an intent to innovate to net zero by 2050. And of course, for assets which are connected to that space, there is some obviously advancements happening at a rapid rate. A lot of industries are having to change the way they do business to basically even connect to that innovation to net zero. I know, for example, today you can't build a property which, that might be much cheaper to build because of the innovation to net zero, because we do live in a climate positive era. In other words, today you could build a weatherboard home very inexpensively on a block of land to lessen the cost of how unaffordable real estate can be, but you can't do that. It's against the law. You need to be able to build a climate efficient, thermally efficient home today with a energy rating of a minimum of 7 stars. And energy rating is no different to, your washing machine or tumble dryer. It's got a little star rating on it, 7 stars, 8 stars, 2 stars, depending on what your budget is. Today, simply put, for a development, for a property to be created, it's got to be connected to the innovation to net zero. And of course, I'm on record saying, well, if that's the way the world's headed, a lot of my assets are going to be sustainable to make sure I'm entering the climate positive era with real estate, whereby I don't have large scale retrofitting costs later if some sort of policy decision was implemented. So I'm trying to bulletproof my real estate world by going in that direction. Not to say I'm right, could be wrong, but that's my belief. So I'm just following my belief. But of course, there are big shifts happening. And again, if we can understand these mega trends, we may be able to build a portfolio which is diverse, but also following what society is doing, what the powers that be are up to. And of course, I think really we are going through a aging population shift at a global level. It is transforming economies. Certain economies are bucking the trend by stealing young people and putting them in their own ecosystem. Of course, Australia is a stealer of people around the world. We go to perfectly good countries and absorb their young, talented humans and put them in our economy so we can work through the aging population effect that's happening at a global level. We've got rapid urbanization unfolding, sustainable cities. We've got green infrastructure unfolding around our town planning instruments. We've got smart cities unfolding at a global level, way cities innovate and move, and how transport and how recycling, for example, is done. So obviously, most of the world, whether it's a big city or a small city, is moving to cities. There's really no such thing as a rich rural country. I don't know of any rich rural countries. There are certainly countries with a rural architecture where they have, like Australia, a big food bowl, but ultimately a lot of work is done in the cities. Without cities, countries, they struggle along. And so you've seen this massive exodus over 50 years of really, the poor farming communities drift into the cities in those third world areas. So again, we're going through transformation, energy transformation. We're moving towards renewables. We're signed up to the Paris Agreement, which again is going to accelerate key sectors of the energy space. And I'm a big fan on energy, pricing power assets. At the end of the day, Maslow's law, we need shelter, food, and energy, and that's the basis of everything. Nothing else exists without that. And I always invest in Maslow's law when it comes to asset accumulation. Obviously, we also live in a digital AI world these days with, future basically jobs and future movement connected very much to the innovations in not only electric vehicles, autonomous vehicles, alongside the revolutionized transport systems. I was just out on a site here in Sydney, and you basically can Uber public transport. A little bus comes and picks you up, and it's a very different, certainly new world to what the past has been. They've got little micro buses now that will take you to rapid transport. So movement, where people live, what people do, it's all connected. And of course, today with AI, with hyperconnectivity, with advances in 5G, there is really the rise of the technology space. And I think really we're just at the precipice of some even further and bigger changes down the track as to the way the world works. We've seen literally a year of AI. What happens in 10 years? What happens in 20 years? Like the technology space is certainly shifting, what it means to work, where it means to live. These mega trends have an effect on everything. And of course, health and wellness is something I've been talking about for a very long time. The idea that healthcare and wellness is really a big player today in society. Aging population, more health workers propping up aging population. 1 in 3 jobs being created today is connected to that. Certainly off the back of, things like the NDIS, things like social and affordable housing. There's changes in the social instability in society. Things are certainly getting stretched further and further apart. And as you guys know, I always talk about the haves and have-nots. But certainly from a wellness point of view, certainly the way I approach real estate is try and find those wellness suburbs. I think suburbs with green space, with culture, with happy humans in them, just make the best investments, because today people crave wellness. People crave, living a certain lifestyle. And it's going to be interesting. The future is going to be very, very interesting. I've got really old parents, and they're in their mid-80s, and they grew up in a completely different era. There wasn't big transport systems. There wasn't the internet. There wasn't, even a plethora of restaurants that, exist like there is today. There was no going to a coffee shop and getting a macchiato. There was Moccona. That was it. And in some respects, I look at the much older members of our community, and ultimately I find them that they don't have a spending consumerism mindset. They were never sort of brought up to, for example, buy Nikes just to trade Nikes, or, buy stuff online from Kogan every day just to try something out, have a bit of a retail gamble. Money was hard to come by. So they lived in a world where, frugalism and thriftyism was part of life. And of course, a lot of older people today are sort of on the pension system, and, they seem to get by. They do seem to get by on the little sum of money which is created from the pension system. But I do wonder, when younger people from today's era join an older era, coming from an consumeristic culture of needing things instantly, whether they'll be able to adapt to being frugal if they end up on the pension. So I just think that health and wellness is even more expansive and goes into the wellness of your wealth, which is incredibly important today. And of course, really a big part of my job is kind of solving that wellness of your wealth issue. And of course, there are just so many forces at play. There's issues of supply chain security, greater localized levels of demand when it comes to a circular economy, a manufacturing economy, an economy that can do its own stuff. It doesn't need to use pipelines and trade routes to be self-sufficient. And obviously COVID taught governments that if you're too connected to the rest of the world and you become dysfunctional in your own world, in other words, you can't do anything, and you're reliant upon the rest of the world, obviously politically that is a minefield, because it means you kind of are politically stuck with sometimes countries you don't want to be stuck with. And so I think understanding all this is critical, because the next phase of building wealth is in a different landscape, certainly to the one we have all known if we've been investing for the last 20 years. The future 20 years different to the last 20 years. But when it comes to any investment, now we understand what's happening in the world. I'm a big believer in just a quadrant that is a selection system. So I use 4 things to make my decision on all investments. The first quadrant is capital preservation. Will I get my money back? Will I be able to get my money out of a deal? Whether that's a real estate deal, whether that's an equity, whether that's a commodity, whatever it may be, I want to know that I have the flexibility to get my money back. Now, obviously, I'm heavy in real estate, which is fairly well an illiquid asset class. You can't really sell real estate in a day. I stick to fundamentals, good suburbs in good cities, where at a bare ass minimum, I can liquidate in a 90-day period. So capital preservation is probably the first part of any investment that I look at. Will I get my money back? Can I recycle money out of a deal? The second parameter is growth. And I'm a big believer in building growth. And of course, in property, I have my own growth model that I developed over my 30-year investment period to put into play. So every time I buy real estate, I follow the great growth model that I use. And of course, the third quadrant is yield. As an investment selection criteria, what kind of return will I get from the investment? And the final investment selection criteria I have is tax. What can I do to improve my tax situation? And is the asset a tax effective asset? So how I select all investments, whether it's a real estate deal or a basically stock market deal, it's kind of the process I go through. So obviously, if you are listening to this show, you're probably a property investor. And so what is a good blend of wealth for a property investor? And again, a financial planner would probably give you a completely different answer to me. So this is just my opinion. It's not actually real advice, but it's just my opinion, and it's obviously what I go and do. My blend to a portfolio is I have 80% of my wealth in real estate. I have 20% in other assets. So I've got other things at play, if you like. I tend to do investment assets, not speculation assets. I tend to stick to some of maybe what are considered more traditional asset classes, shares and property. But obviously that's outside of business. If I was to layer in my businesses that I run, I would say 40% of my wealth is created through business lines. 40% is created then from my real estate investments and 20% from other asset classes. Obviously, a lot of my businesses are connected to real estate. So I have a diverse approach to the real estate in businesses that I run. I work with investors, but I also have businesses that work with homeowners. And so I'm kind of hedged in the real estate marketplace. If for some reason the world said no one can buy an investment property tomorrow, my business would be able to survive because I not only help investors, but home buyers as well, and have other business interests in, other business lines. And of course, if I break down my real estate asset blend, I also have a diversified strategy within the blend of real estate I own. So I have obviously a growth set of real estate in my portfolio. I have a cash flow set of real estate in my portfolio. And I also get involved in accelerator assets, which I understand quite well for a higher level of return. Things like small scale developments where I can put in my capital. I know it's preserved because I'm the one who's the investor. So I'm very confident in my own ability. I can get a little bit of growth. I can get a little bit of yield and also some tax advantages. So that's my trifecta that I work: growth assets, cash flow assets, wealth acceleration assets. I do that in the real estate market, of which 40% of my assets are actual pieces of real estate. 40% of my assets are business assets, and 20% of my assets are other assets. So that's kind of like my world breakdown, if you like. So, Australia is a pretty interesting place. We, in some respects, have a pretty straightforward economy. You guys have heard me talk about it a lot. We are part of the FIRE economy, finance, insurance, and real estate. To make Australia work, sort of put more people in the system, create more real estate, create more financial products, and, more things like insurance. And of course, our big businesses here, really, if you were to look at Australia's biggest companies, they are mining, banking, and farming. And you do have some outliers there which are really improving the economy. Things like Atlassian, which, great tech company here in Sydney. And Melbourne has CSL, a great basically biotech company or biomedical company in Melbourne. They are old company. CSL was born in 1916 in the middle of the First World War. And Atlassian is now a 22-year-old company, which again has a big market cap. So we're pretty blessed here, really, off the back of mining, farming, but primarily the East Coast is very much linked to banking. So I guess we can use some of that sort of business planning. What is Australia? Well, it's farmers, miners, and bankers, and maybe make some decisions about what to invest in. Now, investment-wise, I'm seeing opportunities in Australia's waste and recycling infrastructure. I think if your business plan is basically 40 million people, you are going to create a bigger Australia. You are now also in an environment which is more waste conscious and more renewable based than ever before. And so it's quite interesting watching society adapt to that. And I think that creates a lot of opportunity of a growing business model around, obviously, recycling for a conscious society. So again, there's potential innovation in that growth in recycling space. And it's no wonder we have recycling magnates here in Australia that are effectively, billionaires and, play on the world stage. So I think from an investment point of view, beyond real estate, the waste and recycling infrastructure in Australia is of interest for me over this decade and beyond. Obviously, pie economics plays a big part, as does FIRE economics. Pie is where is the population, where are the jobs, and where is the infrastructure improvement. Why is that important if you are going to be an investor? Well, Australia's business plan, as I just alluded to, by mid-century, another 16 million people. There's something like 300,000 people coming here per annum. And, it's the highest growing country in the world. So if that's going to be the model, then, what type of investments linked to that model? Well, you could look at infrastructure projects as an investor. Some of the big REITs that exist, obviously, are part of those big infrastructure programs. Or you could look at something like Transurban, which is just, more roads, more tolls, and, consistently linked to the potential growth of the population as areas expand. We've got new airports. We've got a lot of things being built to grow a growing population base. Obviously, here in Australia, we are the world's quarry. And so carbonizing or decarbonizing assets makes sense to me. The world is going through this innovation to net zero and looking for decarbonizing assets. what do they look like? They look like lithium, nickel, cobalt, all of which Australia has. Australia has a large proponent of particularly nickel and lithium. And of course, again, having a foot in those camps, which will create a positive impact on the environment through decarbonising, to me makes a lot of sense. And so again, really the way I invest is to link what the world is doing, what the population wants, and what really governments are trying to angle towards to create wealth for myself. As I've always alluded to on this podcast, I'm a big believer in pricing power assets. Assets which in high inflationary periods tend to steal the lion's share of household budgets. I was just looking at some economic data just this morning, and it's quite interesting that really mortgage arrears rates in Australia are still very, very low, despite obviously the cost pressure of interest rates. Why is that the case? Well, people would prefer to pay for their house mortgage over a $400 retail dinner at a hospitality event. So pricing power assets are really those assets which are just a must-have as opposed to want to have. Petrol in the car is a must-have. Power at night is a must-have. Food from the supermarket into the freezer and fridge is a must-have. And a roof over your head is a must-have. So they're very stable in both inflationary periods and deflationary periods. Obviously, there's a point of the unemployment cycle if there's high levels of unemployment where the real estate market does struggle. But the reports I've looked into is the decade ahead is ultimately a low unemployment decade. And again, as a hedge, I think certainly not a hedge. My primary investments are into pricing power assets, real estate being obviously one of them. And of course, it allows for a better hedge against inflation. Properties and obviously real commodities tend to just obviously dominate as a pricing power asset. So there are some trends in the real estate market, and I've sort of talked about these before, but again, like a lot of this is just how I go about investing is really understanding trends. And, we've talked about obviously global trends that can affect other asset classes beyond real estate, but you've got things like inside of the real estate market, the rise of the millennial, the rise of the outer suburbs. You've got the rise of lifestyle locations, of that wellness dynamic. You've got the rise of intergenerational transfer. 1 in 8 sales on the east coast of Australia today is full cash. Like people don't even get a loan. So there is that opportunity in the real estate market to apply your trade and get a result. With building approvals at a 13-year low, it's almost, a given that that's a leading indicator for a problem that will unfold, and that problem will lead to higher property values. When people have less property to visit and look at, they've got less choice. And really what that does is increase the conversion time frame for a buyer to buy. If there's 10 properties to see in a suburb for a buyer, they go and see those 10 properties. If that's considered a high amount of properties, people aren't, racing to buy it. So days on the market spread further and further out. Equally, if 2 properties is considered a low inventory level and there's plenty of people seeing those properties, then all of a sudden the conversion to buy those properties means things are done quicker. Buyers move on properties faster. There's less, dilly-dallying going on. And I think really the trend over the next decade with building approvals at a 13-year low, it's going to be fast turnaround. There's really today ultimately more than one buyer for each property out in the marketplace. And it certainly will actually speed up very, very soon. I think some real estate is going to certainly get the conversion effect unfold on it. Obviously, another pricing power asset is agriculture, is food. Essentially real actual food. And, I've got I've got myself set up in that space. I'm invested in the wheat industry. And again, I think at a pricing powerhouse, the bare ass minimum, people need a bowl of rice or a loaf of bread. And so I'm in the grains space myself. I just think, obviously it's just one of those things that if inflation was to stick around for 5-7 years at a higher level than what it's been in the past, which I think it will, at the end of the day, the ability to produce food is important, and I think it at the basic level of food is probably where I see the best level of investment. Obviously, Australia has a biotech industry, and as we know, there has been constant significant medical advancements and innovations that you see daily on the news. New successful drug treatments, better healthcare, more hospitals opening. Really, if you think about Australia, it has an aging population, and today healthcare and social assistance, along with scientific work in the healthcare space, is really the growing industry base of jobs. And again, sort of thinking about what kind of companies are involved in that sort of biotech space to help people age, to help people live longer, to deal with viruses. And of course, CSL is as good as company as any to take a position on. Obviously, we now sort of recognize that the world will have contagions. Back in the 1920s, we had the Spanish flu, and really we did not have a contagion up until the HIV era, which began in the 1980s. Then by the 2020s, we had things like SARS and swine flu and Ebola and Zika virus. And eventually we had one which impacted the globe, which was obviously the COVID-19 virus, which I never really understand why they don't call it COVID-20, because it didn't happen in 20, but anyway, it must have happened at the end of 19. So worldwide pandemics are a big part of the puzzle. I think maybe things would be handled a little bit differently if there was to be another one. Let's hope not. Let's hope there's not another one. But, with a global world, airplanes flying everywhere, you can't control a contagion. It's just not possible. So, unless it comes out of like a area where there really is a isolated community, but if a contagion starts in a city, it's spreading. So again, I know that sounds a bit dark and maybe giving everyone some trauma from the COVID era, but biotech, it makes investment sense to add to your world, to your portfolio. I think really another interesting position to take, and again, like, you know, obviously the share market, there's less leverage. Real estate market, there's way more leverage. So most people should be taking a higher leverage position in the real estate market. And if it's just a matter of having a liquid asset that pays dividends, you know, some of the things that I think are interesting, you know, particularly in a geopolitical world where there's fights going on, there's gunfights happening, there's battles, there's wars, there's problems out there. And for some people, you know, obviously ethical investments are important. So some things maybe I'm talking about today don't resonate with your ethos. That's cool. You got to invest for you. And I'm just talking about myself. But, you know, one position to take, whether it be a position of what is actually happening with drones, is drones are a big part of militaries today. But equally, I think they'll play a big role in how services are created into the future. So the probably one, I guess, piece of infrastructure that is technology-based, I think we'll see more of into the future is obviously the drone space. The other thing at a global level is the rise of India. You know, India is the emerging market which is taking over the world, biggest population. It's got really a changing of the guard when it comes from basically China to India as really a developing fast marketplace. And, you know, obviously a little bit more friendly to I guess, the Australian world. You know, a lot of free trade happening between Australia and India at the moment, you know, to the point where a lot of Australia's migration is coming through the Indian economy. So again, just sort of thinking about how that can affect assets. What does India need? What do we have? And can we provide it to them? And of course, even inside of housing, as younger families migrate from the subcontinent, a lot of the types of properties that is of preference to that subculture certainly is new housing. And again, if that's going to continue to be a playbook of Australia to basically merge the economy of India to Australia, you're going to see, again, a continued rise, I think, in the real estate space of those outer suburb housing marketplaces, which typically attract, you know, new migration, new people, perhaps living, you know, first home new people who've gone through their university space into their primary home. Obviously, a few outliers, you know, when it comes to what next as an investor. You know, there is talk of the uranium market being, you know, reactivated based off of energy, you know, climate change, confidence around, you know, windmills and solar. You know, a lot of people also are hedging that it's, you know, the amount of stuff you kind of need to get that rolling may be just too difficult. And all of a sudden the role of global decarbonization goes back to nuclear, but nuclear at a kind of, you know, I don't know if you can ever say it's more of a safe option, but maybe a less urbanized nuclear option where some of these, you know, plants are put in outlying areas, and pipelines created. So yeah, you know, again, like these are the mega trends happening. These are the things out there, right? Like you are going to the Paris Accord 2050. I know it kind of feels like the politicians could change their tune tomorrow. But ultimately, that's what the world signed up for. And, basically, many countries, 22 countries, are going to triple their nuclear energy, basically to meet the de-global carbonization. So some countries are going in that direction. So again, Australia has a lot of spot price uranium, and again, makes sense because it's all coming back to probably if you look at those investments, it all comes back to pricing power, energy, food, and shelter. Hence why I tend to invest that way. But hey, today's show is coming to an end, and I would like to thank you for listening. Hopefully that was interesting, but primarily stick to the real estate world. That's where the leverage is. That's where I think the easiest money is over the next decade. We've got some great trends hitting the real estate market, big structural shift down the track with the intergenerational wealth transfer, a lot of money coming into the overall populace in the 2030s. So we know real estate's got a big future. But hey, there's some ideas for you if you want to put some money into the share market and have a go there. All right. Again, I'm no financial advisor, so please ignore everything I just said. And maybe that's the title of the show. Maybe not. I don't know. All right. I better go. See you guys. Take care. Thanks for tuning in to the Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of the Urban Property Investor, take care and bye for now.